All right, everybody, it is 6 o'clock on July 11th, so I'm going to go ahead and get started. For those of you that don't recognize my voice, I am Ryan Herbert, and this is the quarterly economic update for Prostatis Financial Advisors. This is our team. Everybody knows pretty much everybody in all of our photos there, but that's our staff. That is myself and Mike. This is just some of the places that Mike and I have been featured. We have a couple different radio shows, couple different news publications. Once again, this is really just for informational purposes, not intended to represent any specific advice or any specific investment. Past performance does not indicate future results. This really just kind of, it's not a crystal ball, rather just the factors that Mike and myself and the team here at Prostatis consider when we're making market decisions, investment decisions, portfolio decisions. If you have questions, there is that fun little control panel that popped up when you logged in. If you can't see the control panel, you need to press the orange arrow. It's a little tiny bar. You'll see an orange arrow. You press that, and then that'll show you the control panel. Kind of down towards the bottom of that control panel, that is the questions box. If you want to ask a question, please just type it in there, or you can type it in the chat as well. I'm going to try to answer them as I go and pay attention to it. Sometimes they pop up, sometimes they don't, but ask questions as I go along. And as always, if you have any questions after I am done, please feel free to give me a call in the office, 410-863-1040, or you can email me directly. That's ryan@prostatisfg.com. So there's a lot of volatility going on in the market at this point. We are in a true bear market. At this point, the biggest question is whether or not we're going to be in a recession. Recession and bear market are terms that are often thrown around in times of market turmoil. The actual definition of a recession is 2 consecutive quarters of a negative GDP. That is the actual definition, but the agency, the think tank, that the group that officially deems recession just considers it negative economic conditions over a period of time. But for the purpose of our discussions, Mike and myself and the team, we consider it to be 2 consecutive quarters of negative GDP, which we've had one. The first quarter, the GDP numbers for the second quarter of the year have not come out yet, but that is kind of the direction that the U.S. seems to be going, is a recession. These recessions typically happen every 7 years. So this one has kind of been overdue. If you want to talk about the drop that we saw in 2020, it was really COVID related, not economic related, and we had a rather sharp bounce back, so that did not have the opportunity to be called an official recession. But the average depth of these recessions is about 39.5%. I want to say so far for the year, the markets are down anywhere from 22 to 28%, depending which actual index that you're looking at. So one of the things that is still being talked about, and I know I talked about this last economic update, is Secure Act 2.0. I don't know if anybody remembers the Secure Act of 2018, but the 2 biggest takeaways from the 2018 was that we took the RMDs for beneficiaries, for non-spousal beneficiaries. So when you leave your IRAs, your 401ks, your 403bs, your 457s to the kids, they used to be able to stretch that IRA or that 401k out over their lifetime. Now they have 10 years to get all that money out. The second part of that Secure Act that is kind of most important is that they took that RMD, the required minimum distribution, and they pushed it out until 72 from 70.5. So the purpose of the Secure Act, it stands for Setting Every Community Up for Retirement Enhancement Act. So it's really about encouraging people to save money, to have the money in their accounts for a longer period of time so it grows to be a bigger dollar amount, and really try to take your reliance on the government in retirement away from them. So Secure Act 2.0 automatically enrolls new employees as soon as they're eligible at a rate of 3% of their pay. It increases annually every year by 1% up to at least 10%, but no more than 15%. More importantly, it would increase the annual catch-up amount for participants age 62 to 64 up from $5,000 to $10,000. It would allow your employer to make matching Roth contributions to your 401k if they offer a Roth 401k. And also, it allows them to put money in your 401k for younger employees who are struggling with student loan debt. It allows them to put in 401k contributions based upon how much your student loan payments are, even if you're not contributing to that. Other part of it, one of these questions that comes up every once in a while really is creating a national database for Americans to find those lost retirement accounts. You know, I worked for a company 32 years ago and I had a 401k with them, but I can't find any information on it. A database so you can find those lost accounts. Expand those 403Bs out to have all of the features of 401ks because they don't have all of them yet. Allow retirement plans to show you what type of income your retirement savings could provide to you if you turned it all into an annuity, basically saying, take all of my money, just give me an income stream for the rest of my life. It's something that the federal government has been doing with the TSP for years and years and years. On the right-hand side of those statements, it says that based upon age, I want to say it's 62 or 65, this would provide X amount of money per month for the rest of your life. So it's, once again, trying to take the reliance of people relying on Social Security and put it back on the American citizens, the American taxpayers, and say, hey, this is how much money of what you've saved, this is how much money you could have every single month. Like I said, Roth contributions for matching. Another key part of it really is to increase the RMD ages. Really what that looks like is if they pass the plan that is in proposal right now, it would say the required minimum distribution is now 73 starting in the year 2023. It would be 74 in 2030 and 75 in 2033. Really what they're trying to do there is allow you the ability to leave the money in your 401k, your TSP, your 403B, your 457, your IRA. Leave it in those tax deferred plans because some people say, it's dumb that they're making me take this money out because I don't need it. You know, I have Social Security, I have a pension, I have the income that I need. I don't need this money. Why am I being forced to take it out? And so now what they're saying is let's push it back further. Let that money stay in there even longer. That way, your account grows to a larger amount because it's still invested in the market. And now the factor that they have determined based upon your age is a larger number. So the amount of money you take out of your IRA and pay tax on becomes a much bigger number by pushing it out till 73 or 74 or 75. Really, it's a way for them to increase the tax revenue stream without directly raising income taxes. That's my point of view on that. So this is something to be aware of. The House is pushing forward two separate bills that are kind of related to the Secure Act 2.0. So it's something that's worth paying attention to. As always, if something happens, this is one of those things that myself and Mike and Catherine and Andrew will have those conversations with you, our clients, about here are the changes that you need to think about. Here's of the new law changes, here's what applies directly to you from that perspective. All right, so kind of getting into what's going on in the market. Really, you know, inflation really remains, the U.S. economy has significant pressure from inflation. The Consumer Price Index, that's the CPI, it really has been driven by food and energy prices. You know, as of May, the inflation rate was 8.6%, which has been the highest. That's what this is showing us right here. This is CPI, 8.6%, the highest we've seen since 1982. Energy spending, as a percentage of how much we're spending on income, is about a 1% increase. That's really a heightened level for consumers, particularly low-income households, because they're spending a greater amount of their household income on gasoline. Food and energy aren't the only things that we're seeing for inflation. The prices across so many different categories are up. But really kind of what we're showing here is just kind of consumer price, the consumer price index. This really is showing what inflation is. And you can see since 2020, we had a pretty steep drop off when COVID hit. And then it is just so extreme as far as how much we're seeing. The Dallas Fed, which is this green line, it tries to get a lot of the noise out of the numbers, getting rid of most of the extreme price changes in consumer goods and services. And that just kind of shows, it's a smaller number when we factor out really food and energy, but still overall, Americans are feeling the bite at the cash register because everything is going up. What used to cost you $60 at the grocery store is now costing you at least $100 or more. It just kind of overall prices are really up. Really what we're seeing is that the inflation in food and energy, even if we get those two things under control, it's not going to solve the inflationary problem overnight. And that's kind of what the Fed is trying to do by raising interest rates. So what this is showing is just we're at high inflation, which pretty much everybody knows. But kind of looking at signs for the U.S. economy, looking at signs for inflation, really one thing we look at is shipping rates. The cost to ship an item, a 40-foot container, those are the containers you see on ships. The cost to ship one of those 40-foot containers full of goods from China to the United States has finally started to fall off. The chart here is showing the rate, the spot rate, the rate it costs to ship something halfway across the world from China to the west coast of the United States. Really, August of 2019, it was a low rate. And then right in here is kind of 2020. Things started to ramp up. And now where we are at in the year, it has finally dropped off. Instead of it costing over $15,000 to ship a container, it's now right around $8,000. So almost half of a drop in shipping. So the cost of shipping is going down. So this tends to indicate that the bottlenecks are starting to ease. It's not going to be over, but the bottlenecks have started to ease. Another thing to look at is the price of shipping something from China to New York, so even further. Really kind of what we've seen is the shipping, it was pretty close to $20,000 to ship a container from China to New York. Now we're down below the $15,000 mark. Does this continue? That's really the trend that we're following. Like I said, this looks like the start of lower prices in the coming months. It's not overly optimistic because congestion in the U.S. busiest ports in LA and Long Beach is still there, from number one, just overall volume of items and containers coming over. But then again, lack of workforce is kind of another factor in that, the supply chain crisis. Things are falling, but then the demand surge that we're going to see at Christmas, the demand for retailers to bring in more goods, because pretty much everything nowadays is made in China. We can talk a lot about, do we have the ability to mass produce things in the United States that we're bringing in China? Well, yes, we probably have the ability to do so. That takes a lot of time. It takes a lot of time to get a facility, to get manufacturing, to get production, all those things in place and start to ramp it up before it's actually producing. And at this point, we're used to paying a certain price for a certain thing. All of a sudden, if something now becomes paid in America, we're paying American wages versus Chinese wages. Just because I'm used to paying $15 for something that's made in China doesn't necessarily equate to I'm willing to pay $25 for that same item in America. So that is one thing to think about. So rates may edge a little bit higher in the coming weeks as retailers in the United States and in Europe overall start to kind of ramp up for the holiday season. But it does look like we hit our peak in shipping. That seemed like it happened back in September, and we are seeing a steady drop in shipping rates. The housing market, anybody who's sold a house, looking for a house, tried to remodel their house in the past couple months has seen that the price of lumber really skyrocketed there in 2021. Once again, supply chain, workers, COVID, all that stuff kind of contributed to it. We had a pretty nice fall off midway through 2021, and then we had another large spike in 2020. But over the last 3 months, with the interest rates going up, money being more expensive, that really has triggered the housing market to start to cool. Really, the overall demand for lumber is falling. So the prices of lumber are falling. And this is really what the Fed is trying to do. By raising interest rates, they're making money more expensive to borrow. So people are less willing to borrow money to buy things that they want. As there are less people willing to borrow money to buy things, the demand for those items starts to fall. So supply starts to build back up again. And that's when we start seeing those reduction in prices. That is how the Fed is really trying to combat inflation. So lumber prices are down from this year's peak in January. It was right around $1,300 per 1,000 board foot of lumber. Now it's $651 per 1,000 board foot of lumber. So we're going to start seeing these pricings slowly start to trickle through, and we'll see the reduction in prices start to happen probably somewhere close to the end of the year in that manner. I talked about how energy really is a pretty big part of what has been driven by inflation. And what this chart here is just really showing you the annual percentage change of the S&P 500 versus the energy, goods, and services spending as a percentage of personal consumption. So how much money people are spending, how much of people's income they are spending on energy versus the stock market. The S&P 500 on a year over year. So if we look from July to July, it's down about 12.7% for the year over year. But for the actual stock market year, for January through now, it's down about 22, the S&P 500, 24% from that reason. But really what we're showing here is that this is the percentage drop that we've seen for the year over year on the S&P 500. But then you can see we've had this massive increase because of all of the issues we're having, the record high gas prices we're having. People are spending more and more money on energy. And that really has been kind of the only overall bright spot in the economy has been energy prices. Pretty much every other sector has been negative for the year. The stocks that we're seeing here, this is the percentage of stocks that are above their 50-day moving average. Really, we saw towards from February, March, April, we saw this really nice pop in the market, but then it kind of rolled over and died. And really what we're seeing now is more along this line. Like I said, the energy sector really has been running all of the gains on the S&P 500. That's where the spike in oil prices really has boosted profits, and all of the other sectors of the S&P 500 pretty much have been lagging at this point. Financials, healthcare, consumer services, communication services, materials, utilities, all of them are pretty much headed in a downward trend. The only thing that has kind of been on its upward trajectory has been energy, which is why in the overall portfolio, you saw a little bit of play into utilities when it started to lead the other sectors there. a little bit of some exposure into the energy sector, really just to capture some of those gains. So it really just kind of is a slow and steady movement on the market from this point, pretty much all driven by the energy sector, because cost of gas, cost of any type of energy really has skyrocketed so far. There's not really any relief in sight for inflation, I don't think, because everything the Fed is doing is going to take time. Central banks around the world, even the ECB, the European Central Bank, has said that they're going to ratchet up their plans to hike their interest rates. Really, it's kind of changing the way people think, their expectations of what the Fed is going to do, what the ECB is going to do, as to how much of an interest rate hike, how much of monetary policy tightening, that's when they're raising interest rates, are making money more expensive to borrow, how far they'll go to bring inflation, and how sharp of a sell-off it's going to cause in the bond market. The May Consumer Pricing Index report pretty much put to bed any thought that inflation is going to come down soon. The problem is that a lot of the issues that we're facing are supply side issues, which the Fed and other major central banks, no matter how they adjust interest rates, cannot fix those supply chain issues that we're having. The only option available to them is to slow the U.S. and global economic growth down enough without tipping into recession to bring that demand down to meet supply. That's kind of what I'm talking about. We're going to raise interest rates, make money more expensive to borrow. People are less likely going to go out and spend their money because the interest rate on my credit card is too high. The demand falls, supply starts to build up. But really, the expected movement in interest rates for 3-month treasuries, meaning if I put my money away for 3 months on a 3-month treasury bill, by 18 months from June is how we look at this. So 18 months from June, that will put us in the middle of 2023. Really, the target rate at that point is somewhere between 3.75 and 4%, and that's a huge, huge jump from what the forward-looking, the same exact forward-looking report back in March said. They said 2%. This really would be the highest Fed fund rate since 2008. This is really why we, as a firm, Mike, myself, and Catherine and Andrew, we have really been talking about this protection rotation, getting money out of, kind of towards the end of the year last year. Let's move money away from the areas of the market that really outperformed, start transitioning the money into more safe funds. Let's take any money that we had in bonds and start shifting them into our bond alternative investments, because we know that as the Fed is raising interest rates, the value of bonds are going to fall. Any existing bonds that are out there are really going to fall, because why am I going to give you $1,000 for your 1% bond if I can take that same $1,000 and go buy a 3% bond? Your 1% bond is not worth $1,000 anymore. So any money that's in bonds at this point is going to lose money over the next 18 months if we're looking at what this interest rate hike is going to look like. And if you want to find out some more information about the alternatives, if you have not had those conversations with Mike and myself and Andrew and Catherine and John, really, I encourage you to call the office and we'll have that conversation. Here's what we need to do. Here are the adjustments we've made in your portfolio. Here are the adjustments we need to make inside of your 401k or your TSP or your Roth, your 457 accounts, from that matter. Is what the Federal Reserve doing, is it going to be enough? Really, it is too soon to know if the Fed trying to get interest rates up to that 4% target rate, if that's going to be enough. But the market is seeming to say that that's going to be too big of a hike. Our Treasury yields typically converge at the peak Fed funds rate during an interest rate cycle. Really what this chart is showing us is that we need to have room for our intermediate term bonds. Those bonds, intermediate to long term, so that's our 2-year and 10-year treasuries. What we don't want them to do is have a inversion, meaning we don't want our 2-year treasuries to pay more money than our 10-year treasuries. Because if I'm going to put my money away for 10 years, I certainly would want it to pay me more interest than if it was for a 2-year. It's the same thing when people are looking at CDs. If I'm going to buy a 10-year CD, I want it to pay more money because I'm locking it up for 10 years than if I was going to put it in a 2-year CD. And what we're seeing right here, we had a slight inversion earlier this year. It came back up, but the difference between them is only 0.1% or 10 basis points. So if I bought a 2-year treasury, or if I buy a 10-year treasury, I'm only getting 0.1% more than if I put my money in a 2-year treasury. Anytime we have an inversion right here, the last time we had it was in June of 19, and we certainly didn't see a market recession at that point. Anytime this happens, it is historically showing us an early warning sign for a recession. So this is the thing that we're Mike and I are really monitoring. We saw it in 2019. It didn't happen, so it's a matter of will history hold true from that perspective. The tightening of the financial conditions, the monetary policy, credit spreads is really kind of what this is showing us. The difference between the yield in treasuries and those of corporate bonds of the same time frame. So, buying a 5-year treasury or a 5-year bond, or a 10-year treasury or a 10-year bond, investors are now favoring treasury bonds over corporate bonds. The dollar itself has soared to more than a 7% increase so far year to date. A strong dollar really tends to give us a little bit of protection against inflation and slow growth, which is kind of why you're seeing people moving from those corporate bonds, because those corporations are affected by the overall economy, and moving it over into the treasury, which is the US dollar. It does take a lot of time to see the effects of the tightening of this monetary policy on the economy. The impact of what they're doing is probably not going to be evident until December, January, or maybe even February of next year. But in the meantime, those bond markets are going to remain volatile. I think as of June, the average bond was down about 10% for the year. And when you think about where my money should be when the stock market is going crazy, people always think of bonds. Well, we're in this very unique situation that the stock market is seeing a ton of volatility and the stock market is dropping. Typically, I should be in bonds to prevent from losing money. But the reason the stock market is falling, we have that happening, and we have the Fed raising interest rates. It's kind of a double whammy where as the Fed raises interest rates, my safe money is losing money. That is why Mike and I and our team, we've been talking about using those bond alternatives. And so when we look at the overall portfolios from our most aggressive down to the most conservative, the portfolios so far for the year are down anywhere from 6 to 11% for the year, compared to the overall market being down between 20 and 28%, depending which market index you're looking at, and really kind of showing that here is the value. This is the reason why we did what we did with the bond alternative investments. Because it's been a brutal year for fixed income investors so far. The drop in prices, the rising interest rates really has been an issue. Now, we're going to get to a point where bond yields are going to be very attractive for generating income for investor portfolios. Now that we have bond yields that are going to be significantly higher than those typical high dividend paying stocks. And really, this is kind of what we're looking at when I look at overall interest rates. This was as of June 10th here. The average high yield corporate bond, so your junk corporate, was about 7.8%. Emerging market bonds, 6.7%. Preferred stocks, the yield on those has jumped up a little bit to 6.2%. Your investment grade, so your A-rated Corporate bonds are at 4.6. U.S. Treasury 3.8. I'm sorry, the U.S. aggregate bond index is 3.8. 3.2 on treasuries. Muni bonds are 3.0. And then the dividend aristocrats, the really, really high quality dividend paying stocks, right around 2.3%. So really we're seeing this overall yield increase, which will be, like I said, bad for the price of bonds now, but it will be good for income producing portfolios in the future. So one of those things we're keeping an eye on. I mentioned that we're going to start seeing not only the U.S. is raising interest rates, but the European Central Bank finally, after 11 years without a rate hike, has said that they are going to start raising interest rates. Their June meeting, the ECB, the European Central Bank, said that it intends to raise interest rates by 25 points in July, and then another 25 or 50 point hike in September. What that means is 0.25%, and then another 0.25 or 0.5% in the rate hike. For the second half of this year, it seems the market really seems to have priced in a series of hikes on the the market has priced in a series of hikes for the ECB in line with the Fed's course. So it really could offer a little bit of support with the euro versus the dollar. The euro has fallen pretty significantly against the dollar. I want to say it's like a dollar. It's 1.07 on a euro compared to $1 on the U.S. So it's a positive thing if you have a European vacation plan this summer. We might even see the euro fall below the dollar. So while it's good for an American tourist going to Europe, it's really kind of bad for the overall European economy. One of the questions that was asked is, are the yields on annuities going to go up higher than 5% to overcome inflation of 8.6? So, overall, when we talk about yields on annuities, there's kind of two ways to look at it. One way is the stock market, the index annuities, they say stock market goes up, my money goes up. It goes up a percentage of the market, it goes up a multiplier of the market, or there's a cap on it. So as they raise interest rates, those caps will start to move up. The participation rates are going to stay the same from that perspective. And then on the other side, we have those guaranteed income riders that say, we're going to guarantee to grow your money at 5, 6, 7% per year for X amount of years. When you hit the end point of this, you turn it on for income purposes. You will gradually start to see those rates, those guaranteed interest rates on those annuities. You will start to see them come up. Once again, it does take time for those to kind of catch up, because now what those insurance companies are doing is they're going out and they're buying more of these higher yielding bonds from that perspective. So that way they know at a bare minimum, we can give our investors back their money. So now we have a little bit more extra on our spread that we can then give out to our policy holders. But you're not going to see that on the increases on those income riders. You're not going to see those on existing policies because you signed a contract. Really, you'll start to see those on newer policies, the ones they're offering, because they change their products up every, it feels like they change them up every couple of months. They change the participation rates, they change the crediting methods, they change the indexes. Sometimes they change those income riders as well. The bond alternative investments that I've talked about, really, if you guys recall, those are those policies that we have with North American. We had some with Delaware Life, we had some with Athene, and we have some with Security Benefit. Really, those are those annuity policies that said, hey, stock market goes down, I'm not going to lose anything on my money. That's what a bond's supposed to do. Stock market goes down, I'm not supposed to lose anything. Conversely, stock market goes up, I get participation in the market. The North Americans, they're anywhere from 80% to 150% of what the stock market has done. But really the goal of those things is to say, instead of being in bonds where I know is going to lose money, this started back in 2018, when the Fed was saying we're going to raise interest rates. Instead of having my safe money in bonds and knowing it's going to lose money over the next couple of years, let me put it over here, because if the stock market drops and they're raising interest rates, I don't lose anything. And that's exactly what they've done. On the flip side, the stock market goes up, I get that market participation that I would otherwise not have inside a bond. So those are those policies with North American, those policies with Delaware Life, Athene, and Security Benefit. There might be another couple companies in there, but if you have questions about that, I encourage you to just call the office and talk specifically to myself or Catherine or Andrew or Mike. I'd be happy to go over, here's what we did in your portfolio. Here's how everything is working from that perspective. Let's just see. Let's get rid of that one and that one. Okay. Sorry, the questions for me kind of seem like they're really short in there. Okay, so another thing that the European Central Bank really came out and said that we're going to end our QE, our quantitative easing. That is their bond buyback program. Really kind of what you're seeing is, here is the level of bonds that they were buying back in 14, 15, 16, 17, 18, in monetary value, in billions of dollars. And then 2019 happened, they weren't really buying that many. And then end of 2019, they started to buy them back. And in record numbers, they were buying them back. Even, a good bit of it was emergency purchases during COVID. But here you can see, here's the euro, the yield dropped, and now the euro yield, European Central Bank interest rate is really starting to ramp up. They've been climbing sharply as they've been winding down those interests. They plan to stop all of this by the end of the month here and start raising their interest rate in the next week or so. Really what we're seeing is, everywhere across the globe is really trying to control inflation by raising interest rates, making money tighter to try and bring down the overall inflation and the cost of goods. So really kind of what we see overall for the economy is there's going to be continued market volatility throughout the year. You are going to see small movements in the market in very targeted areas. The portfolio at this point is mostly cash because of all of the market uncertainty that we have going on. These are just some of the indicators that Mike and I look at when we're making the portfolio decisions. But I really kind of wanted to show, people are asking a lot about inflation. How does the Fed raising interest rates, how does that help with inflation? I really hope that this kind of answered some of your questions about what's going on in the economy, what's going on in the markets, and what Mike and Ryan and the Prostatis team are doing with our portfolios. Like I said, the portfolio returns so far for the year are somewhere down, from our most conservative to our most aggressive, down between 6 and 11% for the year, which is less than half of the overall market at this point. Any other questions, please feel free to give me a call at the office or call the office and talk to anybody. Mike, myself, Catherine, Andrew, John, Brian, Travis, Faisal, really, any of our investment team from that perspective. You can always shoot me an email, Ryan, R-Y-A-N, at Prostatis, FG. So that's Prostatis, F as in financial, G as in group.com. Thank you to everybody for attending. Thank you to those who asked me a couple questions. And I hope everybody has a great rest of summer. And I hope to see everybody in the office over the next couple weeks. Thank you and have a good night.